Hello and welcome to Securities Lending Saturday. Today we're going to be talking about securities lending and related regulations. So, if securities lending is your interest, then this is the place to be. Welcome to everyone live on Saturday. We do a live stream every Saturday at 1 p.m. BST. So, welcome. Thanks for that. This is the best day of the year weather wise in the UK. So, if you're with me now and you're in the UK, then I appreciate your time. Uh, if you are somewhere else, hopefully you're also having a great Saturday, and we might as well get right to it. Remember, what we do here is the live stream is available on Facebook and LinkedIn. Then the recording will be available later today on YouTube. Right. We do that because it's sometimes hard to find recordings on LinkedIn and Facebook after they've gone live. So YouTube is a convenient storage point. In a minute, I'll put up the YouTube page so you can check it out there. But this is week number 10 in the Fundamentals of Securities Lending series. And I hope you're enjoying it so far. Right. Let me just get my handy dandy deck ready because, as you know, I always share screens and I have slides, and you can always download the slides as well. As soon as I've got that up, what I'll do is I will put up a link so that you can see where you need to sign up so that you can download the slides from this week and other weeks in future. Right. Let me just share the screen. There we go. I always look best in as small a picture as can be. So I'm doing this for you, not for me. Anyway, as I said, we're going to be talking about regulations today. And let me first say hello to Mohammed. Mohammed, thanks very much for joining us. You are the first person to say that you are watching, and if you maybe just want to add in where you're watching from, that would be great. I'd love to know where you are viewing this session from. So, as I said, we're going to be talking about regulation this week. Last week, we covered off the first half of the year statistics. So, we reviewed revenues, volumes, and activity. This week, it's regulations. And next week, it's going to be regulations part two. Because one of the challenges is there's two different kinds of regulation. The first kind really deals with the demand side of the business. So it's about regulations that impact the amount of borrowing activity or the amount of lending activity. These are the three things we're going to be talking about: short selling, the liquidity coverage ratio, which scares lots of people. And then there is the uncleared margin rules, which are a headache for many people. But all of these things have regulations attached to them, which influence how securities lending is traded, how much volume there is, and why there's a demand in the first place. Jack, thanks very much for joining us, and hope everything is great in Jersey today. So thanks for being here. This is, as I said, week number 10. So if you've been enjoying this, if this has been helpful and interesting, then it'd be great if you would just give us a thumbs up and subscribe if you want to see about future videos. Right. Before I get into the regulation themselves, I want to talk about naked short selling. So as I say, naked short selling is not a day trader sitting in front of their computer with no clothes on. Naked short selling, in fact, covers off the practice of executing a short sale, but without arranging that there are securities available to borrow. So basically, you're doing a trade, but you have no way of knowing whether you actually be able to satisfy the obligations, satisfy the obligations of that trade, and that is a problem. Okay, and the reason it's not permitted in most markets is because of these two problems. And there's really, as I say, two issues. The first one is it adds systemic risk. What do I mean by that? If I've sold something to you, then frankly, you don't really care whether it's a short sale or whether I've got it sitting in my broker's account. But if I short sell it to you and I don't have it and I haven't arranged to borrow it, I will never deliver those shares to you because I don't have any shares to deliver to you in the first place. And so, what if you've bought it and then you decide to sell it? Well, you can't sell it because you don't have it from me. And so, that's now a problem, not just for you, but it's a problem for the market because I've tied up this trade. There's no shares involved. I haven't given them to you, and you can't move them into the market. So there's a problem. Welcome, David. Thanks very much again for popping by. Appreciate that. It must be fairly late on a Saturday, or at least Saturday evening. So appreciate you stopping in and saying hi. So part one is just adding systemic risk. You need shares to satisfy deliveries, and the deliveries are part of the piping that keep the market moving. The second reason that regulators don't like naked short selling, and it's bad for markets, is that it distorts market prices. All stock market prices are a result of supply and demand. How many sellers are there? How many buyers are there? And whoever has the whip hand in terms of volume and momentum, that's the direction of the price of the stock. So if there's more buyers than there are sellers, then those buyers will keep putting up their prices until it attracts more sellers. Conversely, if there's more sellers than there are buyers, you're probably going to find that share prices drop because those sellers want to sell and they might undercut each other until they get to a lower and lower price until the buyers are ready to buy. And that's a normal market. Now, in the event of a naked short sale, where the short seller doesn't care about whether they can ever get those shares or not, they could massively distort the supply demand equilibrium or put it out of equilibrium. So if a stock normally trades 100 shares a day, and today there's 100 shares worth of sellers and 100 shares worth of buyers, it'll probably stay similar to yesterday's price. But if all of a sudden a short seller comes in and they don't care about borrowing, they could put an order in to sell 1,000 shares, and that would mess up the prices for the day. And of course, would never be deliverable. So whoever bought them would never receive those shares. So it distorts market prices and adds systemic risk. And that's why regulators don't like it. It's been an illegal practice in markets for some markets for many years. In other markets, a little bit more recent. Now, the important thing to remember is that when you hear people talking about the terrible actions of naked short sellers, that has nothing to do with short selling that is properly conducted. Because by definition, the short sellers that are covering their shares, they are subject to whatever the regulations are in terms of delivery, and they're meeting the obligations of the regulation, which means it takes it into account in terms of supply and demand. So naked short sellers are not the same as short sellers. And more importantly, from a securities lending point of view, naked short selling, of course, has absolutely nothing to do with securities lending because by definition, there is no borrowing or lending activity going on related to naked short selling. So you can't mix up naked short selling with properly conducted short selling or securities lending activity of any kind because naked short sellers don't care about borrowing. Okay, so that's just a general rule. If you've heard of naked short selling, uh, that's a little bit of an explanation. I will probably do a video at some point about naked short selling, going into it in a little bit more detail. Now, we're going to talk about a couple of regulations that impact short selling. The first one we're going to be talking about is Reg SHO, which is a U.S. regulation. The Securities Exchange Commission in the U.S. Implemented that rule in January of 2005, so it's been around a long time. And what it says is that all sale orders have to be marked as long, which means I own the stock and I just want to sell it. It's short, which means I'm now subject to the short regulations, which means I have to borrow the securities, or it's short exempt. Now, short exempt only applies to market makers, and those market makers, because of their service to the market in providing liquidity, they get some elements of special treatment, but they also don't get away scot free. They're subject to some of the rules and constraints, just like everyone else. So all orders have to be marked as long, short, or short exempt. Now, if there's a short sale, there's this creation of this requirement for a locate. So if I want to short sell a stock, I have to find someone who's willing to borrow it, or at least someone who's able to lend it to me. Right. So I have to go out there, I scan all my relationships. They'll tell me which securities they have available, and and I have to identify whether I can short those shares, whether I can actually borrow those shares. So if I want to borrow 1 million shares and I only find 500,000 of supply, then I can only short sell 500,000 shares. Okay. If I can find 1 million shares, then I can short sell 1 million shares. If I can't find any shares, then I can't do the short sale at all. Okay. So as it says, the broker executing that order needs to satisfy itself that there's a reasonable opportunity to borrow those shares before placing the order. And look, the SEC has issued many fines over the years for firms that have failed to comply with elements of this short selling regulation, right? So it's pretty vigorously applied, and it's not just the SEC. There's other countries around the world that have similar rules that have also applied them as well. South Korea is a good example of those markets. Now, so that's the placing of the order. So I want to do a short sale. I find someone that is willing to lend it to me, and so I place the short sale. And then what happens if I make that short sale and I go to borrow the stock and it's no longer available from whoever I searched for? And the problem then is, oh no, the lender I was hoping to get it from, maybe they've sold it themselves and they no longer have it. So I have to go find it from somebody else. And so that's why it's important to have a wide range of lending contacts out there, so that if lender A doesn't have it, you can get it from lender B. But let's say there is no one willing or able to lend out those shares. And so when it comes to the settlement date, there's a fail. All right. That means that the trade doesn't settle, and that's a problem. And as I said, that's what regulators don't want. Now, in the US, settlement date is trade date plus two. So if I do a trade today, 2 business days later, the trade settles. Now, we've got this problem. The trade won't settle because I can't borrow the shares. And that's what this final point is: closeout. If by the morning of trade date plus four for a normal short seller, those shares aren't covered, they aren't borrowed, they aren't delivered to whoever I've sold them to, then it'll automatically be closed out through a buy in. And buy ins are expensive and they're not great for your reputation. So that's what the closeout is there. As I said, market makers, they get an extra 2 days to cover the short sale borrowing requirement and satisfy the delivery obligation. So there's restrictions on identifying what your trading is, then being able to ensure that you have a good chance of borrowing before doing the short sale. And even if that's satisfied and it turns out you can't do that, then there's a maximum window for how long that trade can fail before it automatically gets closed out. Now, there's a question here from David. Is it possible to do naked short sales? Yeah, in theory, it's still possible, because the reality is the only way to know for certain that someone hasn't done a naked short sale is to go check with their records. So, one of the obligations for this locate requirement is that the short seller has to keep records of why they think they could borrow those shares. So, they get a list from all of their lenders, and they'll actually say, Bank A says that they have shares and I have a relationship with them. That's why I have a short sale I have to put a little code to it that attaches that short sale to that code. So the two link up, and I think they have to keep the records for 5 years or 7 years. I can't remember, but they have to keep those records, and the regulator is allowed to go in and check their records anytime. And that's what some of the fines have been for, is that people either didn't have records or they had insufficient records. They had insufficient information to prove that they had a reasonable opportunity to borrow those shares in time. But the only way to know that for certain would be if you actually went and checked their records. But practically, if someone does a naked short sale, they'll be closed out by this trade date plus 4 or trade date plus 6. So it's still possible in the U.S., but it should be the risk of it should be mitigated by these closeout procedures. So, David, hopefully that answered your question. So that's the U.S. The short selling, locate requirements, record keeping, and closeout obligations have been in place there longer than most countries. So that's pretty much a matter of routine. And as I said, where the regulator has found that there have been inconsistencies, inaccuracies, or incompleteness or failure to comply, they've assessed pretty hefty fines. Now, if we flip over to the European Union, the European Union rules came in after the market crash in sort of 2008 and the Lehman default. And so, as it shows here, it came into effect November 2012. And really, there's a few different aspects to it, but what you have to understand is that in Europe, there's really two levels of regulation, which I'll come back to in a minute. Noel, great to see you there. Thanks for stopping by. I've missed you as well. Things have been crazy here this year. It's been the craziest year, much weirder than last year. So I haven't had the time I've had in the past, but great to see everything's going so well for you. Look, I learned from you as well. And I think both have learned from Rollis, the master. So thanks for dropping by. So as I said, as far as European regulations go, the reality is we've got sort of two market level regulations here, because the ESMA, which is the European Securities Regulator, they kind of have an umbrella responsibility across Europe. And then, of course, each individual country has their own regulator, and the two can act in sync, and sometimes they have different views. So the local regulators are called national competent authorities, because they're the ones that are actually putting in the regulations within their nation, and ESMA sits over top of it. And the way the regulations are empowered is it gives these national competent authorities the ability to temporarily restrict short sales and change the reporting thresholds, which I'll come to in a minute. But of course, there is also the possibility there for ESMA, as the overarching regulator, to override and force one of these national competent authorities to implement a regulation that ESMA wants them to put in place. So it's kind of an interesting dynamic, if you ask me. Now, ESMA has looked at it from two different perspectives. The first is, as I said, this sort of systemic risk reduction element of it. And that's primarily focused at naked short selling. So, again, in Europe, you have to do the same thing. You have to be able to locate shares before you can do the short sale. And the key objective there is to reduce the risk of settlement problems. Okay, so systemic risk reduction, it's difficult to say on a Saturday, is one of the objectives. The other objective that Europe has, which is not in place in the US, or in fact, really anywhere else, is this whole sort of increase of transparency about short selling. It's really a very important pillar of the European regulations. And so, what they require is that for short positions, short sellers have to disclose to regulators anytime they cross over more than 0.2% of the issued share capital of any company that in Europe, that where they have a short position. So they have to tell the regulator, look, we've got a short position in this stock of 2.2% or more. And then at each increment of 0.1% above that, they have to report again and update that. And that's sort of the next day. So I take the short position today, I have to report it by tomorrow. And so not only do the regulators get that information, but if the figure goes to more than half a percent of the issued share capital, the short seller has to make that publicly available so everyone in the community can see that there's a large short position in that name. And then again, in increments of 0.1% above that, they have to update their records and say we've taken an even bigger short position. Okay. Now, that little asterisk at the bottom is that after or in the immediate aftermath of the market crash last year, uh, regulators in Europe, so ESMA, implemented a reduced threshold. So they said, forget about 0.2%. We now want you to report to us on 0.1%. So a much lower threshold. And that expired a couple of months ago. But ESMA has said they got so much useful information that they want to have it permanently lowered to that 0.1% level. And that's actually under consideration at the moment. So it might be that the reporting threshold has gone even lower. Now it's been interesting because in the U.S. in the aftermath of the meme stocks, and GameStop, AMC, and the like, there had been calls from some places for this kind of same disclosure level. Now, I'm not going to go into this. I've written blogs about it, and I probably would do a video about it at some point. I'm not keen on this public disclosure. The regulatory disclosure, fine. I'm not all that keen on it being as low as it is because it's not symmetrical for long investing. So to me, that shows an ingrained bias against short sellers. That's not the topic for today. These are the EU rules. So ESMA and the national competent authorities, they look at the same thing for naked short selling to make certain everything is covered, and increased transparency is critical from their perspective. So that's the EU rule. And both of these things have an impact on the amount of short selling activity because you're constrained by how much you can borrow and if you can borrow it. And that's also dependent on your relationships, your credit worthiness, the turnover of the stock itself. So it's kind of a self policing mechanism to restrict short selling activity to an amount where the market can absorb it. And that's important. Now, we write a blog post every week, myself and my colleagues. Um, we've covered short selling and securities lending many times. We've been doing this for about, I think, 18 months, a little bit longer, not quite 2 years yet. So here's a few that I've pulled out, and I'll put these comments into the show notes and the description below. Um, One is securities lending in a well-functioning market. How does it actually contribute to that? uh, Immediately when the Europeans put in a short selling ban, so several European countries, but also South Korea, Malaysia, 8 countries in total put in short selling bans last year. I did a blog post that talks about whether short selling bans work or not. So you can read that there. We got a guest author in, a portfolio manager who talked about the ethical implications of short selling. So you can see that in that blog post. And I think last week, my colleague wrote a little bit of an analysis on some of the most shorted stocks and the impact on share prices. And he looks at it and says, you know, share prices, in his view, don't seem to care about short selling volume. So that's an interesting one to read there as well. Again, all of that will be in the show notes. What I will do just very quickly, I'm just going to put up the caption as to where you can download these slides from this week and from previous weeks. And that will be, if I can find that. And in the meantime, I'm just going to keep talking to you and pretending as if I'm easily going to find this, which is obviously, there it is. Look at that, as if by magic. So it's just one of the bit.ly links and it's just Securities Lending Fundamentals. So SL Fundamentals. If you go there, sign up. We'll send you the slide decks from the previous shows, and then each week you'll automatically receive the new slides. So you just need to sign up once for that. Okay, so hopefully that's it. Bit.ly SL Fundamentals, and you'll be able to download these slides. Okay, let me just carry on here. Next slide. So, what we've talked about so far are things that have impacted the short selling side of the business. And while that's important, there's another side to this business. So, this business is a mixture of short selling and other borrowing activity. So, some of it is, well, every short sale should have a loan attached to that. But not every securities loan is for a short sale. And the next two regulations will give you an idea as to why government bond borrowing has grown so dramatically over recent years. And again, if you go to last week's slides, last week's show, where I talk about the first half statistics, you will have seen that government bond lending continues to rise. And I predicted that it will continue to rise going forward. So the liquidity coverage ratio really got its start in the parched earth lack of liquidity in the markets in August 2007. So that's when, as far as the US goes, that's when the subprime crisis started to take root. And what I mean by lack of liquidity is that banks stopped lending to each other. If you had cash, then you kind of hoarded that cash because you didn't know if anyone was going to go out of business. You wanted to keep that liquidity in case some kind of market impact happened and you needed to make certain you had the cash to operate. So markets really dried up and there was no cash that was easily flowing throughout the market. And regulators looked at that and said, that's a pretty bad thing. And in fact, in the UK, one of the banks here famously had to be taken over, bailed out by the government because what they were doing is they were borrowing their money, their treasury financing needs in the short term money markets and lending out longer term things like mortgages. And that normally is great because it's usually cheaper to borrow money on a short term basis than it is a long term basis. So if I can borrow money cheap, lend it out expensive, I make a profit. And that's great until you get parched earth and there's no liquidity. And so that bank needed to be bailed out. Regulators looked at that and said, that's not a good thing. So they brought in this thing called the liquidity coverage ratio. And as it says here, it's to really improve the short term resilience of banks. And the basis for the calculation says, dear bank, you need to be able to prove to your regulator that you can operate your business for 30 days without having to access liquidity from the market. You need to be effectively self financing for 30 days. Now, that might surprise people that banks can't normally do that, but banks really are just intermediaries. They take money which they, from depositors, which they have to pay back to depositors, and they lend it out to other people and they make a spread on that. So they don't just sit on piles and piles of cash doing nothing. Every asset they have, they try to put to work. So to say to a bank, you need to have effectively enough money or enough assets, including cash and securities, that you can finance yourself for 30 days without accessing external markets. That's a big ask. So this has been implemented over recent years. And the idea is that banks have to either have cash surpluses or they have to have high quality liquid assets, so government bonds typically, although that's not the only kind, that they can have at their disposal so that if the markets freeze up like they did in the summer of 2007, and that really lasted for most of the next year, um, that they can actually liquidate those assets by either selling them into the market. So they're not accessing it, they're actually just selling something and getting proceeds. Or if the markets have frozen up, they can always finance that with their central bank, their local government central bank, or another central bank. So that's why these high quality liquid assets, government bonds, are really in so much demand. Now, banks don't necessarily want to buy it. And any assets that they do have that satisfy that, they might have to use them for other obligations. So, one of the ways that they access these securities, if you recall I think it was week 4 where I did the trading demands for securities lending, I talked about collateral transformation trades. So there's someone that's a HQLA holder. I'm an investor. I have government bonds, and I now have a bank or a broker dealer coming to me saying, I'd like to borrow those government bonds, and I'll give you some other collateral to hold on to that. Now, that bank that borrows them can either use them for their day-to-day business obligations, or they can just sort of stockpile them. They can sit there and say to the regulators, see, this is part of my liquidity coverage ratio reserve inventory. These are the assets that I would use. And that works. You might say, well, hold on, they borrow them, they don't own them. But effectively, what that bank has done in that trade is they've taken assets that the government or the regulator doesn't think are liquid enough or high quality enough, and change those into assets that are. So the end impact is that that bank or broker dealer has what their regulator thinks is good quality assets, and that's what the objective of it is. So this is one of the main reasons why government bond borrowing activity has increased and will continue to increase, irrespective of what happens in the stock markets. So that's one regulation. The second one deals with derivatives. So I'm not going to go into too much detail on this, but there's two types of settlement of derivatives. One goes through a central counterparty or a clearing organization, and the other one is bilateral. So rather than trading it on an exchange and having it settle through a normal mechanism, you and I might just do a derivative contract. And that's great, except now we both have exposure to each other. And that market has continued to grow. And they're also typically not standard trades. So they're difficult to offset against other trades. So they carry a risk, and the bigger the business, the more risk it carries. So uncleared margin rules really look at sort of protections on a bilateral basis that both parties have to live up to that reduce the risk. And there's two parts to it. One is initial margin. So when you do the trade, you have to put up a amount of collateral that is relative to the size of the trade, and then the variation margin, which is kind of a revaluation every day. Broadly, think of it as a daily profit and loss settlement. It's not exactly that, but that's a close enough analogy. And these rules have been phased in because this is quite a big change to history. So regulators have been implementing this or applying this to market participants over the course of a number of years. And the basis of the rollout has been based on the value of transaction that you do. So if you're a big participant in these bilateral transactions, you were captured earlier. And as time goes on, the threshold for being captured has been reduced and reduced. Okay, so these two aspects of a variation and initial margin, they mean that one party or the other has to post collateral. Okay, and again, as I said, phases 1 to 4, they're already live, and those are the biggest entities. Phase 5 happens in a couple of months from now. We're doing this in July of 2021. In September is the next phase, and then a year from then is the following phase. And of course, because you're doing it by the amount that's on loan or that you have outstanding in derivative contracts, the lower the threshold, the more the number of firms that get captured. So a greater number of firms will be captured by the UMR, uncleared margin rules, in September than before. Although the value that the first 4 phases have cumulatively is definitely bigger than the next couple of phases. So it's kind of this 80-20 rule. The first 20% of the firms that got captured, they have 80% of the volume. Now you're going for the other 80% of the market participants, and they have 20% of the volume. Now, again, what's the impact of all of this? It's the same kind of thing. It's that same need for giving collateral to counterparties, which you may have. And if you don't have it, then you have to go get it. And we see these HQLA trades being the driver behind that again. Okay. So that's really the main comments I want to talk about. As I said before, every week we have a free primer for those of you looking for a 50,000-foot overview on securities lending. That's about a little bit under an hour. It's free and it's on our website. And of course, we have a securities lending course. We also have repo courses and a course on collateral management, which goes much more into the derivative obligations there that I just talked about in the last slide with uncleared margin rules. Okay, so you can find that there. Right. Hold on. Let's go to the next slide. Right. Let's just do a summary of where we are today because we're coming up to the 40-minute mark, and that seems to be the magic time for this. Regulatory restrictions, they reduce the impact of short selling from a negative perspective. So by making certain that you can only short shares that you can borrow, it restricts the amount to deliverable market absorbable sizes, and there's penalties there for people that don't follow the rules. The liquidity coverage ratio covers the or makes it a requirement for banks to be able to operate in really arid, dry, no liquidity market conditions, and that creates a need for borrowing government bonds. And finally, the last point, the uncleared margin rules. So securities lending, by being able to borrow these government bonds, is one of the tools that market participants use to satisfy the need to get collateral for their derivative exposures. Right. So that's it for this week. As I said, next week I'm going to be talking about part 2. I know people have asked me for to talk about the SFTR, the Securities Finance Transaction Reporting Regulation. I'll talk a little bit about that next week. So next week is much more about sort of the ancillary things. Today it was about trading and the demand drivers. And next week it'll be about the other sort of cloud of regulations that apply to this business. But I will be still doing a separate one on SFTR. Also, keep an eye out for another video that I'm going to be doing, um, which will be focused on 3 questions and 3 answers in under 15 minutes on securities lending. So, over the next coming weeks, I'm just going to be answering 3 questions a week. I have a few of the questions that have already been sent to me, but if you have questions that you want to have answered, don't hesitate to email me or put them into the comments here. Again, just a wrap up for everyone. The first 10 minutes of this will be live on, will be recorded and available on Facebook and LinkedIn, but the rest of the show will only be available as a recording on YouTube. So that's it for me. I hope you were able to stay awake for regulations. I can't say that I love regulations, but they are obviously important drivers. David, thanks very much for the comments. I really appreciate you staying around for the whole thing, especially on a Saturday. So thanks for that. But look, regulations are our world, and regulations aren't going away. So we need to understand what they are and what the impact of them is. And we'll be talking about part 2 next week. Until then, have a great weekend, have a great week, and see you next Saturday. Over and out.